challenge the dollar's dominance as the global reserve currency, BRICS nations have laid the first tracks for a new and alternative digital payment system called Bridge. And this payment platform is still in its infancy stage, but it is a start. Our next report telling you more about how the BRICS countries' alternative payment system in a way challenges the Western-controlled SWIFT system.
Saudi Arabia announced it would not renew the petrodollar agreement. This decision reflects a broader trend of de-dollarization, where countries are increasingly seeking to reduce their dependence on the US dollar for international trade. This shift is part of Saudi Arabia's strategic move to diversify its economic partnerships and align more closely with emerging economic powers like China and the BRICS nations.
The coalition of developing countries led by China, India, Brazil, Russia and South Africa, or the BRICS nations, are planning to develop a new global payment system to rival the US dollar-based SWIFT network. Now, this will be high on the agenda when India hosts the BRICS summit later this year.
Saudi Arabia has officially ended its 50-year petrodollar agreement with the United States, shifting to a multi-currency system for oil sales. Well, this transition allows Saudi Arabia to sell oil in various currencies. This move coincides with Saudi Arabia's participation as a guest nation at the BRICS Outreach Ministerial Meeting in Russia. Well, BRICS now comprising 10 full members, including Saudi Arabia, Egypt, Iran, UAE and Ethiopia.
Breaking around the world today, a major shift is quietly unfolding in the global financial system. For decades, the US dollar has been at the center of international trade, especially in energy markets. Oil, gas, and many key commodities have been priced and traded in dollars. This system, often called the petrodollar era, has shaped global power, trade flows, and economic stability since the 1970s. Now that long-standing order is facing new pressure as the BRICS group takes coordinated steps that challenge the dollar's dominant role. BRICS is a bloc made up of Brazil, Russia, India, China, South Africa, and several newer members. Together, these countries represent a large share of the world's population, natural resources, and economic growth. In recent meetings and policy statements, BRICS members have made clear that they want to reduce their reliance on the US dollar for trade and reserves. They are not announcing a sudden replacement of the dollar, but they are building alternatives that could slowly change how global trade works. The facts are important to understand first. In recent years, several BRICS nations have increased trade using their own local currencies. China and Russia, for example, now settle much of their energy trade in yuan and rubles instead of dollars. India has explored rupee-based trade mechanisms with multiple partners. Brazil and China have also signed agreements to trade directly in their own currencies. These steps are not symbolic. They are being used in real transactions involving oil, gas, industrial goods, and agricultural products. At the same time, BRICS institutions like the New Development Bank have expanded lending in local currencies. This reduces exposure to dollar-based financial systems and lowers the risk of currency shortages during global shocks. Some BRICS members have also increased their gold reserves, a move often seen as a hedge against currency volatility. Central banks across the bloc are adjusting how they manage foreign exchange reserves, gradually reducing the share held in US dollars. Energy markets are another key area. For decades, oil priced in dollars helped create steady global demand for the US currency. Recently, some major energy exporters have shown openness to accepting payment in non-dollar currencies. Long-term supply contracts, pilot transactions, and bilateral agreements are testing this idea in practice. These deals are still limited, but they mark a clear change from past norms. None of this means the dollar has disappeared from global trade. The US dollar remains the most widely used currency for international payments, foreign reserves, and debt markets. US financial markets are still among the deepest and most liquid in the world. However, the trend lines are shifting. Analysts warn that even gradual changes can have major long-term effects when they involve systems as large as global finance. Now let's look at what this could mean. If BRICS continues to expand trade outside the dollar, global demand for dollars could slowly weaken. This could mean higher borrowing costs for the United States over time, as constant foreign demand has helped keep interest rates lower. It could also mean more currency volatility, especially during periods of global stress as markets adjust to a more fragmented system. For developing countries, these changes could offer both opportunities and risks. On one hand, trading in local currencies may reduce exposure to dollar shortages and sudden exchange rate shocks. On the other hand, weaker or less stable currencies could increase risks if not managed carefully. Building trust in new payment systems takes time, strong institutions, and clear rules. For global trade, a more multipolar currency system could emerge. Instead of one dominant currency, several major currencies might share influence. This could reduce the power of any single country to shape global finance through monetary policy or sanctions. Analysts warn that this shift could also make coordination during global crises more difficult as shared standards become harder to maintain. There are also implications for geopolitics. Currency dominance has always been linked to global influence. By reducing dependence on the dollar, BRICS nations are seeking greater strategic autonomy. This does not automatically lead to conflict, but it does change how power is distributed. Economic tools that once had strong impact may become less effective if alternatives are widely adopted. It is important to avoid extreme claims here. The petrodollar era is not collapsing overnight. What we are seeing is pressure, not destruction. Systems built over decades tend to change slowly, then suddenly. Small adjustments today can lay the groundwork for larger shifts tomorrow. This could mean a long transition period where the dollar remains powerful but no longer unchallenged. Technology also plays a role. Digital payment systems, central bank digital currencies, and new settlement platforms make it easier to trade without using traditional dollar-based channels. Several BRICS countries are investing heavily in these tools. If successful, they could lower transaction costs and speed up cross-border payments, making non-dollar trade more attractive. For ordinary people, these developments may feel distant, but they matter. Currency shifts can influence inflation, job markets, energy prices, and the cost of imports. If the global system becomes more fragmented, supply chains could become more complex. This could mean higher prices in some areas and new opportunities in others. Markets are watching closely. Investors are paying attention to currency reserve data, trade settlement figures, and policy signals from major economies. Analysts warn that sudden moves or miscommunication could trigger market volatility. At the same time, gradual and well-managed transitions could reduce shock risks. In the end, what we are witnessing is not a declaration of war in the traditional sense. It is an economic challenge to a system that has defined global trade for generations. The language may sound dramatic, but the reality is shaped by policy choices, contracts, and long-term strategy rather than sudden confrontation. The key question now is not whether the dollar will vanish, but how the world adapts to a future where it shares the stage. Will this lead to greater balance and resilience, or to new forms of instability and competition? As BRICS continues to push for change and the global economy adjusts, one thing is clear: the rules of money and power are being quietly rewritten. So as this story continues to develop, here is the question for you. Are we watching the beginning of a more balanced global financial system, or the early signs of a more uncertain and divided economic world? What we are seeing right now is not a single event, not a dramatic announcement, and not a sudden collapse of the global financial system. It is a slow, deliberate shift that has been building quietly over many years. The moves by BRICS countries to reduce dependence on the US dollar are part of a broader pattern of change in how nations think about money, power, and security. These changes may appear technical, but their effects reach deep into the global economy and everyday life. For decades, the dollar-centered system offered stability and predictability. It made global trade smoother and helped standardize prices, especially for energy and raw materials. That system also created strong incentives for countries to hold dollars and invest in U.S. financial assets. Over time, this reinforced the dollar's dominance and made it difficult for alternatives to gain traction. But dominance can also create vulnerability. When one currency sits at the center of the system, shifts in its value or policy direction can send shockwaves across the world. BRICS countries appear to have taken this lesson seriously. By expanding local currency trade, increasing gold reserves, and investing in alternative payment systems, they are attempting to spread risk and regain control over their economic futures. This does not mean they are abandoning the dollar completely. Instead, they are preparing for a world where reliance on a single currency may no longer feel safe or sustainable. Analysts warn that this kind of preparation often signals deeper concerns about long-term stability. This could mean the global financial system is entering a transition phase. In such periods, uncertainty tends to rise before new norms are established. Markets may react sharply to policy signals, and investors may struggle to price risk accurately. Currency volatility could increase, and capital flows may become less predictable. At the same time, new opportunities may emerge for countries and businesses that can adapt quickly to a more complex system. One possible outcome is a multipolar currency world. In this scenario, the dollar remains important but shares influence with other major currencies. Trade could be settled in different currencies depending on region, commodity, or political alignment. This could reduce the burden on any single currency and create more balance. However, analysts warn that coordination becomes harder in such systems. During global crises, unified responses may be slower, and disagreements over standards could increase. Another possible outcome is fragmentation. Instead of a balanced system, the world could split into loosely connected economic blocs, each with its own preferred currencies and payment networks. This could mean higher costs for global trade and reduced efficiency. Businesses might face more currency risk, and smaller economies could struggle to navigate competing systems. This could mean that economic growth becomes more uneven across regions. For energy markets, the implications are especially significant. Oil and gas are not just commodities. They are foundations of modern economies. If energy trade becomes less dollar-focused, pricing mechanisms could change over time. This could mean more regional pricing differences and less transparency in some markets. Consumers may feel these changes through fuel prices and energy bills, even if they are not aware of the deeper financial shifts behind them. For governments, these changes demand careful management. Moving away from established systems requires strong institutions, clear rules, and trust between partners. Without these, alternative arrangements could increase risk rather than reduce it. Analysts warn that poorly coordinated transitions can lead to financial instability, especially in countries with weaker currencies or limited reserves. For ordinary people, the effects may be indirect but real. Exchange rates influence the cost of food, fuel, and imported goods. Financial instability can affect jobs, savings, and access to credit. While these changes unfold at the level of central banks and international agreements, their consequences are often felt at the household level. This could mean periods of adjustment where costs rise before benefits become clear. It is also important to recognize that history shows currency dominance does not last forever. Past reserve currencies rose and declined as economic power shifted. These transitions were often slow and shaped by trade, innovation, and geopolitical change rather than sudden collapse. The current moment fits this pattern. The dollar's role is being questioned, not erased. Its future will depend on economic strength, policy choices, and global confidence. What makes this moment different is speed and scale. Technology allows financial systems to change faster than before. Digital platforms, instant payments, and new settlement tools can spread quickly once trust is established. This could accelerate shifts that once took generations. At the same time, this speed increases risk if systems are not tested carefully. So when people say the petrodollar era is collapsing, it is more accurate to say it is being challenged. Pressure is building from multiple directions, and alternatives are no longer theoretical. They are being tested in real-world transactions. This could mean the next decade looks very different from the last. In the end, the story of BRICS and the dollar is not just about currencies. It is about how the world shares power, manages risk, and responds to change. It raises deeper questions about cooperation versus competition, stability versus flexibility, and the costs of dependence versus the risks of independence. As the global economy stands at this crossroads, the outcome is not predetermined. Choices made today by policymakers, businesses, and institutions will shape the future financial order. Some paths lead to balance and resilience, others to uncertainty and division. And so the final question remains, as the dollar faces growing pressure and new systems take shape, are we prepared for a world where financial power is more widely shared, or are we underestimating the challenges that come with rewriting the rules of global money?